introduce today's speaker, Brian H. Lucas, who's the VP of Development at Wieland. He has over 15 years of experience in real estate finance, development, and construction. Brian has specific real estate experience in acquisitions, entitlement processing, and capital markets. As a co-founder of Prime Urban in 2004, Brian was responsible for acquisition and entitlement of approximately 150,000 square foot of commercial space, 3,000 residential units, and 250,000 square foot of urban mixed-use development. In his role of VP of National Sales in the capital markets sector, Brian led efforts in various roles to raise approximately $750 million of real estate equity through both public and private real estate funds. Brian's previous employment includes VP of Sales and Operations for Blue Rock Capital Markets, principal and co-founder of Prime Urban. His professional qualifications include a light construction and development management and at the University of California, Irvine, the FNIRA Series 7 and 63 licenses. He received his architect and construction management degree from Cal Poly, and then an economics degree from Southern Methodist University, and has leadership development from Vanguard University. Quite a distinguished career so far. So please welcome Brian Lucas.
Is this on? We need to fire up the blue. Well, thank you. It's always funny when somebody reads your resume and you're sitting there wondering who they're talking about as they're reading your resume. So it's always an honor to be in these sort of circumstances. I really appreciate it. And obviously, this is a last minute. I think there's got to be some sort of like man code about these sorts of things where typically you shouldn't ask one of your colleagues to give a presentation without telling them exactly who they're following. So on Thursday, obviously, you had an incredibly talented, gifted, Nobel laureate, award-winning presenter. My friend Randy failed to mention to me that I was following someone of such a high caliber, so I don't know if I need to apologize in advance or what, but one of, I think, my principles of success in business has been not to try to be more than I am or less than I am, but be exactly who I am. Not to try to, overstate who I am or my capabilities, but do the very best at who I'm created to be, and so that's my goal today. That being said, as you've heard, I have some pretty unique experiences in a number of different parts of the real estate process, from the underwriting, the entitlement, acquisition, construction, development, capital markets. And so I think I can offer a really unique perspective on real estate that is both practical and sound. Ultimately, the big idea, or what we try to do, is to make really complex things simple, and as simple as we possibly can. And that really is the hardest work that we do. It's one thing to communicate something that's incredibly complex. It's another thing to communicate that complex idea as simple. And so I've had a lot of great practice with that. My wife and I have 4 kids that range from 3rd grade to 12th grade. We have 2 girls and 2 boys. And so we're dealing with Common Core curriculum and math and trying to figure out how to communicate that to our kids and help them to learn and grow. But my theory in complex ideas is if I can explain it in crayon, then I feel like I've got the idea. So we're not going to be crayon presentation or slides today, but I'll try to get down to that level at some point. So here's what we're going to do. I'm going to kind of take us through this PowerPoint and this presentation in 3 different sections. And first, in sort of the high level, I'm going to pontificate a little bit about general economic conditions, market. The next one, I'm going to make it practical. I'm going to apply it specifically to real estate, and not just real estate philosophically, but specifically how deals are getting done. And then the third piece is really to make it personal. And the reason for that is the goal, I think, of these events is to help you be successful at whatever it is that you've set out for yourself. I've been to a number of different conferences like this, and I always find myself really engaged in the content, and in some ways disappointed in not connecting more with the person providing the content. Because there's a story behind the presenter that is powerful, and there are lessons there that I'd love to share with you. Specifically, we talked a little bit about this around our table. Some of your most profound lessons in business and life will be through, I won't say failure, but challenges, right? And in these presentations, we typically always talk about the successes. Well, that's really not going to translate into really powerful, practical tools for how you achieve the things that you've set out to achieve for yourself. And so I'll end on sort of the personal note. And what you're going to find in the presentations, there's going to be a meta-narrative through this. And this, a really dear friend of mine who is one of the founders of a firm called IntraWest, up in the Pacific Northwest. He, when IntraWest went public, he then transitioned into developing a huge portion of downtown Seattle. And now he has an advisory firm. He could retire probably 10 times over, but he loves what he does. He'll never retire because he loves what he does. And he's in this really interesting place where he's giving away power. And so he's become a dear friend and a mentor, and he was just presenting at the ULI in Philadelphia. And he said, Brian, as talking to him on the way up here, he said, Brian, I want you to communicate something to the audience today. And so I'm sort of waiting for this really profound nugget of wisdom. And he said, I want you to tell them that interest rates rise and interest rates fall. And then he said, and then stuff happens in between. I didn't use the word stuff, but in a way, the simplicity of that's crayon, right? I mean, that is the simplicity, and he has so many stories behind that to sort of support that. But what we're going to see in this sort of meta-narrative that's going to run through this presentation is that one of the key highlights that we're seeing is this concept of a sharing economy, right? So the sharing economy. People are living large, but they're carrying less in real estate. So they're still living these big dreams. They're still living large. They're still pursuing the highest end in many ways. They're still pursuing the dream of advancing. So they're still living large, pursuing the big dream, but they're carrying less. And what that means is, if you look at companies like Airbnb, Uber, even us as a company, which I'll describe a little bit in a moment, the idea is to genuinely squeeze value out of assets, and do that through disruptive technology and by unparalleled and unprecedented efficiencies. And so if you think of Airbnb, they are absolutely disrupting the hospitality market, and they don't own a single hotel room. That's powerful. If you think of Uber, they're disrupting public transportation and the taxi service. They don't own a single cab. That's powerful. So those sorts of themes and technology are starting to permeate into real estate. I want to describe what that looks like. Simply put, technology aggregates the current zeitgeist of our culture. So what technology is doing, if you think about this in terms of real estate, it's simply aggregating what's underneath the surface. It's bringing it up, and it's creating efficiencies around that previously were impossible. So we're going to talk a little bit about that in terms of how it affects real estate. So just briefly, as we look through this, the order of real estate market growth and ultimately downturns follows a pattern, and this is not new to anybody. GDP growth, then job growth, and then improvements in fundamentals. So we have this whole presentation will be sort of framed around that concept. Very simple, but easy to understand. So as we look at gross domestic product growth, we should expect about a 2% GDP growth into 2016. Okay, so we're going to see continued slow growth driven by stronger and more confident consumer. And the thing to remember about this is that 70% of GDP is made up by consumption. And so now let's make this practical. The way of thinking about this is maybe in 08, 09, 10, right? People are maybe buying used cars or maintaining their current vehicles. Now people are actually buying new cars, but they're buying the 3 Series instead of the 5 Series. That's sort of the general mentality of what we're seeing in GDP growth. Consumers in a better spot as we look at the employment rate, the job market. Obviously, we see wage growth, but there's an important component to wage growth that I want to discuss. So we are seeing minimum wages that are starting to increase over a period of time, but what we're seeing and what I'm seeing is that actually wage growth is happening by employees jumping from company to company. So the duration that employees are spending at companies is significantly less than they have been in the past. So as a result of that, what we're seeing is we need to be aware of resume building versus wisdom creation. I almost feel like we're gonna have an intelligence bubble at some point. Because the idea is that the concept of staying at one company and loyalty and building, sort of this career that's long-term at one company, that's very antiquated. So as a result, people are jumping from spot to spot and building resumes, but their correlated information and wisdom and true depth of knowledge in their industry is going to become pretty shallow. And so it's something to look out for. I think we potentially will see a generational Peter principle that I think we need to be aware of. So just something to look out for and to be aware of. So I have a principle called the frugal wife principle. And in many ways, the slowing GDP growth of the US, or just sort of the 2% growth, we'd love to see the 3%, but because we have a slow global growth, it's sort of inhibiting our ability to reach that 2%. So it's going to hover around that 3%, hover around that 2% spot. And I think this is because of what I call the frugal wife principle. And so my wife, I called her for many years the COO of the Lucas family. Well, this last year she was promoted to CFO. And it was very disruptive to the Lucas home, because all of a sudden, the nickel and diming and the things that would occur when I was the CFO and the CEO of the Lucas home, those things were put to an end. And so what ended up happening is some of those goods that I would buy on a whim, or the family would buy on a whim, the wife brought them back in and slowed it down. And all of a sudden, it's simple math, right? If you save $50 here and $50 there, and she's putting it away, all of a sudden, guess what happens? The savings account grows, and it creates all these other opportunities. And so I think what we're seeing on a global scale is simply what I call the frugal wife or the frugal husband principle. And so we see that, I think, played out pretty specifically. And so I'm going through these sort of more macro slides pretty quickly, because I know you probably spent a couple days going through this, and so we'll go through these. And I really want to get to the area of focus, which is real estate. If we look at these two slides, what you'll see is there's a basic correlation as oil goes, so the stock market goes. And all of these slides are basically setting up the foundation that direct real estate investing is still a very primary, and the fundamentals are very, very strong. So as we look at the 10-year yields are low and likely will stay low for a longer period of time. Again, all this is setting the stage for, I believe, are strong fundamentals in private real estate investing, direct investment. And so I call it direct investment because still the whole idea of direct investment in real estate is that it's non-corollary and you don't experience the volatility that you have on the wider markets. What's interesting, if you look at the REIT market, there is a correlation there, and so you achieve some of the benefits of real estate in terms of dividend payment, but you're still subject to some of the volatility. So although real estate is still, I think, fundamentally strong, you're still subject to the same volatility that is in the general markets. And so again, setting a context for what I believe is very strong proof for direct investment in real estate. This is just another example of the frugal wife or husband principle. Rates will have a really hard time adjusting up, even with Fed action. Rates today are lower now than the average over the last year, as every central bank but the US is in easing mode, which is tough for rates to rise when all the easy money out there and stimulus continues. So we're going to see lower rates for longer, which is great for real estate. We look at the US Treasury yield. Oh, I don't like this slide. I told Randy I was taking it out. I'll try to take it out because I don't want to be taken out. So what we'll talk about in the real estate market. what we've seen is that this is really set up, again, a context for direct real estate investing. So what we have to do is step back and say, what are the existing options for real estate and why? Well, again, it's non-corollary, there's low volatility, it's a strong alternative investment that's income producing. And let's look at a few of those. And I want to talk about this slide and a few others going forward in the midst of this whole sharing economy concept. So we're going to see moderate economic growth, which is the continued improvement of fundamentals in all property types, and they're going to continue to get better. So what we're seeing in the apartment market, how many of you have heard of, we'll start in office, with the company WeWork? Anyone heard of the company WeWork? Interesting. Okay, so WeWork is a sharing office concept. Creative office, collaborative office. So the idea is it's like fractional ownership, but for office space. And so this company was started during the downturn period, and they went out and acquired a significant portfolio of office. And what they did is they created a platform where technology allowed you to use office space in fractional increments. So in other words, you could walk into this incredibly well-designed, creative office space. They have happy hours on Thursday nights. They have kegs open for free, gourmet coffee, because what these people are doing is paying $600 a month for membership to the office. And it's catered specifically for this millennial creative working force. Do you know what WeWork was just evaluated, what their valuation was? It's $16 billion. So it's something I think that is incredibly disruptive. And of course now they're expanding their platform into something called We Live, which is the same concept but for living. So what we're seeing is this sharing economy that exists now in hospitality with Airbnb is now being translated into office space, the living environment, and I think soon we'll see it across the board in real estate in one key area that I'll bring up later in the presentation. Here we're going to see really what we look at in terms of projections of NOI growth. There's a couple of key segments that I want to look at. First of all, hotel. If you look 2013, 14, and 15, you have this dramatic growth in NOI. Well, what was projected around that time in 13 and 14? The big I word, right? Inflation. And so hotels historically operate the best as a real estate investment sector in periods of inflation, because what can you do to your rate in your hotel daily? Adjust it. So you can adjust your what's called ADR, your average daily rate, every single day as inflation increases. So you're actually growing NOI in a way that you can't when you own an industrial building that has a 15-year lease on it with a locked-in rate over a 5-year period. So think about this in terms of sector investing. In periods where there's projected inflation, you want something that has high lease rate turnover, like hotel. The second best sector to invest in would be self-storage. You saw tremendous allocation into the self-storage space because of the same principle. You pay your first month and then you sit on it, and there's high turnover in that self-storage space. Same thing. You can adjust those rates incrementally up as you experience inflation. The third sector would be apartments. The average rent roll turns 50% every year. So again, you can begin to gradually increase rents according to inflation. The other thing I want us to notice is the office. So whereas you have hotel that's decreasing as we see a projection of continued low interest rates, what do you see in the hotel sector? Well, you have projected increase in NOI. Well, that's because those lease rates are locked in for 5 to 10 year periods of time. So what happened in 2006, 2007, 2008? All of a sudden people were taking over office space at incredibly low lease rates, taking over more space probably than they needed, because they were able to lease Class A office space, in some cases Class B office space, at 50 cents on the dollar. So they're occupying all these spaces at a 5-year lease, locked in over that 5-year period. Well, those leases are beginning to roll just as we're starting to see an improvement in job growth. So what is a very tactical sector right now to be investing in? and I'll talk specifically about this a little bit, Class C and Class B office in core markets. And here's what we're seeing. Large institutional firms are basically acquiring, I have to manually do this, there we go. They are acquiring portfolios of real estate in office in a Class C and Class B space, anticipating the opportunity to increase lease rates. And here's what they're doing. They're acquiring these offices and they're putting in deferred capital maintenance. And they are upgrading them into this Class A space and creative workspace. So they're starting to mirror this WeWork concept, and they're upgrading the entire space, opening it up, putting new fixtures, amenities, polished concrete floors, and they're spending somewhere between $100, in some cases $300 a foot to upgrade the office space in preparation for the opportunity to re-tenant at higher lease rates. So all of a sudden, you bought an asset that, let's say, had a $1 per square foot lease, and you spent on a per square foot basis about 50 cents, annualized, and now all of a sudden you can lease that office at $3 a foot. So it's an unbelievably tactical play, which we'll talk about a little bit more in a moment. I lost my connection here, so I'll just do this manually. And so what this means is, as we start to look at this over the next few slides, is in the construction market, we're starting to see a very slow recovery in construction. And so typically, the average is that you're gonna build about 1.75% of the existing stock, all right? So you're gonna build about 1.75%. There's still a pretty fundamental spread there. We're still not up to that average level of 1.75%. A lot of that is due to the overbuilding that occurred, pre-recession cycle. And so what we're excited about is we're actually starting to find an equilibrium. We're starting to slowly get to that point where we're building about that 1.75%. And so the economy is really doing what it's meant to do. And in some way, this frugal wife or husband principle is acting just as the global market should. It's stabilizing itself. So if there was only one of me in the Lucas household, I do better at making money than I do of managing our money at home. I like to spend and buy stuff that you just got an iPhone. Why do you need to upgrade again? And why do you need 2 iPhones? Well, it's cool, and I like new technology. Well, the frugal wife principle comes in and says, nah, no, you're gonna lock into that 2-year contract, and maybe in 2 years we'll look at it again. That's what's happening in the world. It's the same basic concept, and the market is really finding a great equilibrium. However, I think part of that is because we're all sort of waiting to see. We're sort of standing back and looking at the principle that's keeping things in check is also a potentially, it could also be a very disruptive principle. So I think everybody is sort of waiting to see what the next 1.5 to 2 years looks like. The general consensus is that we have an unbelievable amount of dry powder to deploy into real estate, but investors, including ourselves, are being very disciplined. We're underwriting very conservatively. We want to find great deals, and I'll talk a little bit about what that looks like here on the next few slides. So transaction volume, the demand for real estate will continue. We'll keep cap rates low. We look at the spread between the acquisitions, total transaction volume, and cap rates. That spread will continue. We'll still have low cap rates because of our continuing low interest rates. But the reason for that is institutional investors still don't have very great options for this non-corollary income producing investment class. So here's what's gonna happen. I think here's the opportunity. Ultimately, we're here to protect, preserve, and make lots of money. How do we do that in the real estate market? Let's get down to why we're here, right? That's what it's about. So there are tremendous amounts of capital on the sidelines waiting. So how do we take advantage of that? What does that look like? Well, big institutional players are looking for tactical investment opportunities. And so a lot of the funds that we look at in terms of global real estate, this is a very, very, very interesting slide. In the previous 3 years, which is sort of that Notre Dame gold color, previous 3 years, you see what the total investment in real estate was, right? In the last 12 months, That's what the investment real estate has been over the last 12 months. So you see this acceleration of deployment of capital into real estate that in 1 year, for example, Canada has invested 50% of what they invested over a 3-year period of time. So all of a sudden there's this acceleration of investment into real estate. This is also exciting for people who want to make money in real estate. So if you look at the bar on the left, that shows what the investors, and these are all public pension funds, what investors' average allocation to real estate is in their portfolio. So each of these portfolios have their allocation strategies, right? So the average allocation, for example, in the public pension funds is about 9% into real estate. And so their target allocation is 10%, which means there is dry powder waiting to invest in real estate. And here's what it looks like. Private real estate investment capital ready for deployment is steadily increasing. Part of it is because of this low cap rate environment. So what this means is, in order for these large funds to make really good investments, it requires a very disciplined local approach to real estate. There's something called the winner's curse. Maybe you've heard of the concept of winner's curse? So the basic concept, just in summary, is that just because you were successful in your hometown doesn't mean you're going to be successful in a town in another state. It's not always transferable. So one side of the street is a good place to buy, and if you're sitting at a desk in New York and pushing a button, and you think, well, geez, cap rates were X on this side of the street, surely I can underwrite the same cap rates on the other side of the street. Well, you know that that's not always true. And so what's happening is global investors, institutional investors are actively looking for local partners. And here is the opportunity, I believe. The big challenge is how do you deploy hundreds and hundreds of millions of dollars and billions of dollars into local real estate? You can't know all the markets. And so there's an unbelievable and I think unprecedented opportunity for local investors to partner with institutional capital. If we look at global investors, it's the same. We have the dry powder that's looking specifically for investments in the U.S. Let me tell you a story about what this looks like. So I have two friends. One friend's name is Brian. It's not me, Brian. It's another friend of mine named Brian. And another friend named Brad. So Brad is an investor in San Diego. He's a developer, local guy, was a broker at one point, started his own company with a partner. Brad knows every single deal transaction in downtown San Diego. I had a large equity group that I introduced Brad to. We drove the streets, and at every corner, he said, that building is leasing for X dollars a square foot. That building just traded at an X cap to this person from that person. There's a project that's being designed here. It's entitled for this many units. They're underwriting at such and such. The rental rates are this and that. He was an encyclopedia of knowledge with regard to real estate in his local market. He owned that market. And that very, very high net worth capitalized investor left incredibly impressed. Second story, a guy named Brian. He's a developer in Orange County. He's a deal guy, right? So he knows about the deals, not great at numbers, sort of macro level understanding of his market. We toured the market, and he just talked about big ideas. And when I said, Brian, how much did that building trade for? I don't know, I'll look it up. Okay, what's the occupancy on this apartment complex? I think it's, so you can see sort of where the story goes. Now, Brian was a very successful investor and developer in the past. Who do you think the investor went with in the future? That person who had done their disciplined research on the market. Because what large funds are looking for are partners that are informed in the local markets to be tactical. Because cap rates are low, because there's a lot of money coming into the market, it requires a level of knowledge, local owners, that only certain people can take advantage of. So I want to make you aware of that. Again, it is all about, I think, making money And the reality is it takes just as much time and effort to do a $5 million project as it takes to do a $50 million project. So as these large funds are looking to deploy, they're looking for intelligent people who know the market. What one sponsor said is they would rather have a B investment with an A sponsor than an A investment with a B sponsor. Which means in order to drive that NOI, it takes a really good operator, very disciplined, very sound business strategy. So just in closing, this is a very simple graph that shows that some of the public real estate REITs are basically trading at NAV, so they're finding their equilibrium. You can expect about a 7% return, so you kind of get close to the efficient frontier of 8%. But what it shows is it creates an opportunity for this tactical investment, as I've described. And one of the key fundamentals of that is liquidity. So we're looking for asset allocations that have both consistent income as well as the opportunity for liquidity to take advantage of these opportunities as they come about. So that was sort of practical on the real estate side. But on the personal note, my encouragement to us in this room as we define what success looks like for us individually, and what success looks like for me. So, I was a part of this great run up into 06 and 07, and I experienced what was an unforeseen tragedy of events in real estate in the Great Recession. And one of the great lessons that I learned, wisdom is the ability to not repeat mistakes. And how do we do that? Not only as individuals, but as corporations, as governments, and as a society. The one great encouragement that I would give to you is to find a mentor. It sounds so fundamental and easy, but there's nothing more empowering or powerful than somebody who believes in you, and somebody who will support you, and somebody who has seen the road ahead in a way that you could never see yourself. And so, what I would encourage you to consider is find a mentor. Actively seek somebody either within your learning institution, in the private sector, whatever that looks like for you, actively pursue a mentor. Your success, in many ways, I believe, will depend on that mentor. And the truth is, in my life, is that it has created opportunities. It's leveraged my own skill set and experiences in ways that I never could have imagined. So I encourage you to do that. Find a mentor. And here's the other side. Here's the tough side of that equation. If nobody wants to be your mentor, what does that say about you? It's a tough word, but the truth is, if you can't find a mentor or nobody wants to mentor you, maybe you need to make a change. Because leadership is fundamentally about being willing to learn. It's a humility of not being more than you are or less than you are, being exactly who you are. And if we're always posturing to be something great, then those mentors will see that maybe you don't have anything to learn. But we do, we all do. And I think as a result, it makes, we would do these closing dinners when we would close a real estate deal. And it was always the thing we'd look forward to, right? So when we're negotiating hard and trying to get the right amount of to buy the property, and super contentious, in some cases long and drawn out and dramatic, at those points where we'd just be like, let's punt this thing, it's not worth it. We would look at each other and go, well, where are we gonna have our closing party? Where are we gonna go? And we'd sort of start to carve out what this would look like, and the mentor would be there. And so the point of that is success is always better when you're sitting at a table with people around you. Wine makes things better. And so I would encourage you to buy Fresno State wine as much as you possibly can. But find a mentor. Success is defined in relationships, doing great business with great people. I think it'll not only make you successful, but it'll make the process, you will endure through the process, and you will scale your own success in a way that you would have never have seen possible. So I want to thank you very much for the opportunity. I look forward to meeting as many of you as I can personally, if given the chance. And thank you. I appreciate it very much.
most interesting part of my job of, on behalf of all of us, giving a token of appreciation to our speakers. And this is just a token to you and to Dr. Randy Anderson. And since you liked our wine, and so on, I have two wine, one for you, one for Dr. Anderson.
I'm gonna take both the wines and I'll give this to Dr.
We didn't have time to make you a plaque. I'm sorry.
You can't drink it.
I was trying to carve your picture right next to it, but.
My question.
Yeah, there are questions for you.
Oh, yeah.
Come on here. Go ahead.
Hi, my name is Krishna Dandapani from Florida International University. I have two questions. Number one, do you think there is a bubble in the real estate market because of low interest rate and the increased value in the dollar? And my second question is, if you have money to invest, which segment of the real estate market would you recommend?
Yeah. So, disclaimer, I don't have a looking glass, but I have indicators. Part of what I do is, I'm currently doing is I'm advising the federal government on some distressed real estate in Seattle. And this was a portfolio, it's about $350 million worth of development, partially constructed, that was financed through EB-5 funds. And EB-5 is a really convenient equity instrument that doesn't have a lot of regulation around it. So in some ways it captures the interest in global investment without any regulation over the distribution or use of those funds. So it's pretty dangerous. As a result, this specific developer, not all EB-5 deals are this way, but I think the lack of regulation and oversight creates an opportunity for it. This developer misappropriated these funds. So why do I bring that up? I think we have to define what a bubble is. So in our mindset, when we think bubble, we think the big bubble that we just had. And so, no, I don't think that we're going to see that. I really don't. But I do think that we see a different type of bubble, which is the influx of global investment into the US, into core markets. And so you see these extremely low cap rates. In a lot of cases, these international investors are left trying to make a decision between very few options, the US being the best. And so as a result, there's this competitive process of acquiring these really key Class A properties that are driving down cap rates and inflating values, I think, artificially. So I think we're gonna see, I think sort of an interesting thing. We're gonna see a correction, I don't know if I call it a bubble, but I think we're gonna see a correction in value in some of our core markets, but it's not gonna be extreme. I don't think it'll be disruptive. So that would be number one. I don't think, maybe 2 years out, 18 months to 2 years out, I think we're gonna see a correction that will create opportunities. So where would those opportunities exist? I personally like, I really like real estate in core markets that's underutilized. So for example, I'm looking at a 3-acre piece of property in Orange County for retail, way underutilized. The idea there is simply to add value through better, more professional, efficient management, so you're driving NOI, or by an entitlement process to increase the development potential. So I like those really key kind of tactical sort of value add opportunities. I would stay away from big ground up development. I think we're gonna see a really strong supply of apartments that are gonna flood the market. I think it's gonna take about 12 months for that to wash out, 12 to 18 months. So I'd say, for new starts in apartment, I would probably put a pause on that. I would look instead to acquire existing assets, reposition them, and try to increase NOI that way, as opposed to making all your money just through a distressed acquisition. The fundamental in real estate is you make money when you buy real estate. You preserve it, protect it, you increase it through great operation, increasing your net operating income or creating value or revenue that didn't exist before. And then you capture that value when you sell it. So I like apartments still, buying existing in kind of core markets and some secondary markets. I like office. I don't like Class A high-rise office right now because you're gonna have to compete with the foreign investment money that's very aggressive. So I'd like sort of mid-rise, Class B office that have upside potential.
Thank you.
Yeah, no problem.
Any other questions? Thank you so much.
Yeah, you're welcome.
Okay, on your tables there are wine, and I know some of them are empty, some of them have not been touched, some of them half empty. You're welcome to take them. And as you know, with the about 3:30 p.m. The conference comes to an end, and I know a number of you guys are leaving tomorrow or Sunday. If I don't have a chance to see you, I just wanted you to have a safe trip back home. And I love you, respect you, and hopefully we see you in New York. And those of you who are going to Yosemite, please let Marlo know. But I wanted all of you guys to join me and thank my students and assistants sitting at this table, including Marlo, Corey, Jose, and Nambir, and David here, a cameraman, and Mo, the other cameraman. And I just wanted you to know that if there were some kind of deficiencies in terms of room service, food service, whatever, just ignore it. Simply because, I wanted to get it in a newer hotel. There are newer hotels by Hilton, by Marriott, small, but as you know, those hotels have one meeting room. And one meeting room means one meeting room. And we need 5, 6 meeting rooms for concurrent sessions. And of course, the rate here was really, really reasonably discounted for us. So it was a beautiful hotel when I joined 30 years ago. I stayed here. And at that time was a Piccadilly Inn, and there were 3 of them. Family dispute, divided each hotel to one family member. The person that inherited this essentially messed it up, went through auction through 2008, and a New Zealand family bought it after the crisis, messed it up. They wanted to do a fast buck, and a year and a half ago, 2 Vietnamese brothers bought it, and they bought it also through auction. And Brian was talking about real estate opportunities. This very hotel, I think, was probably purchased for about $5 million, with almost 200 rooms, huge facility, all these commercial properties around it included, that generate rent. And I think that probably in a year and a half or 2 years, the brothers made a really, really good. The value of this today is over 15 million. So what Brian was saying about opportunities comes and knocks, it does. And any questions for me, by the way?
Yes.
Yes.
Any similar hotel or option?
Yes, there is. Yes, there is many places. Brian knows more than this, but it's called LoopNet, LOOPNAT, and there are some commercial listings, and there are of course some private consultants like Brian and these real estate companies. I'm not a real estate guy. And but I do invest, by the way, a little bit in real estate over the past couple of years. This crisis turned me into a mini real estate investor. And just give you 1 or 2 examples that opportunity exists in your environment. When your money is sitting in a bank or any other investment and earns nothing, and negative return of probably negative to 2%, I bought a bunch of properties here for about $100,000 each, and they're generating about $1,100 monthly rent. You cannot beat that. They are, not so desirable neighborhoods. But I have a manager that really, really like a family, and his crew are helping us. And he owns, I guess, about 30, 40 of them. And opportunities in every corner on earth exist. And I know a lot of people, historically financed guys like myself, thought that real estate is alternative investment. And not too many people focused on really return on real estate investment. People like Randy, that is not here, have done a lot of work on that. And of course, Robert Schiller, as you know, is in the forefront and Nobel laureate. And I share with you one real life story with Robert Schiller that I think is very, very interesting. 2005, he was our keynote speaker. At that time, he was not a Nobel laureate in Dublin. And on a one-on-one dinner with me, I talked to him, and I could see all the time, over the past probably 15 months prior, that he was on TV, CNN, and all these other channels, and he was beat by Wells Fargo real estate guy, Bank of America real estate company. All these experts like this guy were telling him that you go back to Yale and you're an academic. And I remember that bunch of radio shows that said that this guy is a cuckoo. But of course, he was not a cuckoo. As you read his resume and books that he wrote about animal in all of us, and behavior and all these bubble economy, and he's in the forefront of bubble. He was talking about bubbles, so he and I are having dinner in Dublin, and I say, Bob, what do you do on your personal front? What should I do when I go back to Fresno? He said to me that if you have a wife like me, you can do nothing. But if you can control your wife, there are so good opportunity to do it. I said, okay. He said, how much is your house worth? I said, probably about $980 to $1 million. Go back home, say, honey, let's sell our house, lease it back for 3 years, and 3 years you buy it at half price. True story, by the way. I come home and I say, honey, my wisdom tells me that this bubble is gonna burst. I just got confirmation from this friend, and let's sell our house. We're not gonna move out, and we're gonna buy it back for half price in 3 years. We're gonna pay $3,000 rent. You don't have to move anything. And my wife is a dietitian, says, all you think about is money, you teach money, you live money, you whatever, money, 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 money. No, this is my life, this is my kids, no way. I said, okay. I had a line of credit with Citibank, untouched, about 2007, mid-2007, a letter came from Citibank and was sitting on the kitchen counter. She reads them and I read them, and she said, did you sell our house? I said, no. I said, did you borrow money on the house? I said, no. She said, why did they reduce our line of credit by $265,000? I said, remember, honey, 2 years ago I told you let's sell the house. The house is now down by $265,000. Comes March of 2008, a second letter from Citibank. Your line of credit is reduced now to only $143,000 from $500,000. It's just the same question, the same answer. I said, what does it mean? It means that you and I lost $500,000 for you telling me money, 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 and not listening to me. You're serious? I said, yes. He said, how much is the house worth now? He says, probably around $500,000. I said, that $500,000, we could have bought 2 houses fully paid for our kids. And he says, next time I'm gonna listen to you. I said, I don't know if I'm gonna. Next time I'm gonna be around for a bubble to burst. So I just want you to know that there are opportunities in real estate. I'm a little tiny guy, by the way. But, you know, and of course my distinguished department chair and friend for a long time since college, is running is our student run fund. You heard about him. I do not know what portion of his portfolio is real estate, but I know he's big in stock market. I consider real estate stock market a big casino. I remind you to look at John Bogle's book on that Wall Street is nothing but a big casino, and the dealers are Goldman Sachs. Any question, comment? Oh, GFC next 2017 is going to go to New York and it's going to be hosted by Hofstra University. Please mark your calendar for July of 2017. We are negotiating, finalizing with Gold Coast in Australia for 2018. I have my doubts because last time we were ready to go to Gold Coast, almost everything done. As you remember, I told you we're going to go Australia. And in December, because of some changes in the top administration, they sent me a contract, 400 pages, the legal department prepared, that if you wanted us to host this, these are the things you need to do. And I read the first line, it says, if somebody is walking on our campus and falls, Fresno State is going to be responsible. If somebody is getting into fight or poison in a restaurant, I said, what are you doing? You're just hosting the conference. Why do I have to put all these obligations? Pure and simple. Bottom line now, he's insisting that this time is changed and so on, but we're considering other places. There are good places. For 2018 is a long way away. We wanted to go to Venice. As you remember, a couple of years back, my friend had some heart issues. He's here, he's a good guy, and I know that he had emergency medical, and I don't know, maybe we forgive him and maybe we consider going to Venice, Italy. But for now, please plan for 2017 July at Hofstra University in Long Island. And in Long Island, they do not have bed bugs and those type of things that you find in Manhattan. Just want you to know that. Any other question, comments? So this concludes our 23rd Annual Global Finance Conference. Thank you, love you, have a safe trip back. Those of you that I do not see, those of you that are going to Yosemite, I'm not gonna be your tour guide, even though I like to talk too much. But I want you to know that I'm gonna, as I mentioned, 2 vans, but we need to know your name, confirmed, to Marlo so that we make the arrangement, and then we will let you know exactly about the time. If you want, when you meet with Marlo, say you prefer 8 or 9, leaving, return 5 or 6. Those are the 2 options you have. It's not gonna be, oh, we wanna go 6 a.m., wanna come back 10 p.m. It's not gonna happen. Thank you so much.